Hello, fellow Rebel Capitals. Hope you're well. I am here with my good new friend, David Levenson. And like I said last week, I met somebody, I kind of kept it a secret. I met someone in St. Bart's that is part of that, or was part of that primary dealer system. And he had an incredible framework that, quite frankly, I had never heard before. So he was nice enough to come on this week and join us and kind of explain that framework face to face. So, David, thanks for coming on, buddy.
Thank you so much for having me on. And I do have to give a big shout out to our good friend Hugh Henry, because without him, I wouldn't have had the opportunity to meet you. And now I consider you a good friend. You're someone I respect. And whatever connection someone senses about you through the video, George is even nicer than that. He's just so warm and engaging and bright. And it's so fun to be on with him. And especially now.
Talking, David. Keep talking. Forget the banks. Forget your framework. Just keep telling me how great I am.
Oh my God, he's just so terrific. You know, he has an alternative name. It's called the Universal Translator. He can listen to any one of us with our Chinese, our hieroglyphics, our Rosetta. He's the Rosetta Stone.
We'll
Rosetta Stone radio.
Put that to the test today, David. So
Okay.
let's start off just taking things very slow, because you speak in a different language, and that framework that is completely fascinating that I was talking about earlier, it is rather esoteric. And I want to make sure that the whole entire audience is following along kind of step by step. So let's start by going over your macro view. In other words, what do you think interest rates are going to do? Let's just say over the next year. And is that a fair time horizon?
Well, let's do 1 year and 2 year.
Okay, but let's go over what you think interest rates are going to do, and then maybe what you think the dollar is going to do, and then maybe the Mag 7 and the S&P. And then once we establish that, then we'll try to connect the dots and have you explain why you think those outcomes have the highest probability. So let's start with interest rates. What do you think interest rates will do over the next year at the front end, long end, and the belly of the curve?
Okay, so I just like to preview this as saying, I'm not looking at this as a gut instinct or an intuition.
Right.
I'm looking at this kind of as a mathematical formula, policy of Powell or our government or other central banks. Those are what we call superpositions. They're temporary wavelets of policy, but they cannot interfere with the system. The system has $900 trillion that generates $1 trillion a week. It needs a place to go.
Talk about derivatives, David.
Well, no, just if you added up the value of housing, equity, commercial, if you add derivatives, that's an additional 2 trillion. Excuse me, an additional 2 quadrillion.
Right.
So we have almost a quadrillion of what we call cash or assets. And then on top of that, notional derivatives, we have 2 trillion compiled. And a derivative is another fancy name for an involuntary behavior. I'm not going to be preaching on here, but it says, in the Bible, don't borrow because you have to pay that back and you might break a rule. So when you're doing derivatives, you're actually just taking leverage. You don't actually own what you're doing. So let's go back to the beginning. 900 trillion, 5%, that's 45 trillion. That's about $1 trillion a week that has to buy something. So central banks printing money, pumping up the money supply can absorb some of it. But once you start seeing maximum credit formation, which we can discuss later, which means you don't have rising demand for money as evidenced by rising short-term yields, that means we're in a credit deflation environment, which leads to an equity deflation environment, which then leads to a price deflation environment. It's a cycle we've seen starting September 3rd, 1929, March 24th, 2000, September 15th, 2008, when Geithner pulled the rug out from Lehman Brothers. And then we started to see it when June 12th, 2024, Powell reduced the level of quantitative tightening by $35 billion per month, $420 billion a year, which mathematically equates to about a 42 basis point rate cut just in the 5 months before the election. So we're seeing credit demand decay, and it has so many implications for everything. I'm so glad to be able to kind of run through it. So the forecast is much lower mortgage rates, which are going to cause much lower short rates and much lower long rates.
Okay.
And yeah,
Because most people would see that the opposite. They would think, okay, lower long rates, lower short rates, and that equals lower mortgage rates. But for you, you think the mortgage rate going down could be the catalyst
oh
to
yes, for
what
sure.
you consider
Yeah.
a bull flattener. Is that a correct way? And
So
by the so for the audience, it's for the audience. The bull flattener, guys, is where the 10-year treasury yield is going down and the 2-year treasury yield is going down, but the 10-year yield is going down faster than the 2-year, because right now there's about a 60 basis point spread between the
62,
two.
yeah.
Yeah.
And that's flattened a little during the day.
Yeah. So your view is that over the next year or two, not necessarily because of what the Fed's doing, but because of mortgages, and we'll get more into that in a moment, you think that the
Yeah.
10-year will go down faster than the 2-year. And I would assume faster than Fed funds. Is that correct?
Well, so what happens is we have two rates. We have a policy rate, which is a 1-day rate. That's the overnight rate. The Federal Open Market Committee's
Right.
a policy rate, and that's 4 3/8. It's in a range of 4 1/4 to 4.5. And then we have the market rate. And my favorite piece of paper is the Ultra Bond. It's 10,000 days long, but most people care about a more liquid 10-year Treasury.
Mhm.
We had, just for context, before the Fed started easing policy on September 18, 2024, we had a massively inverted yield curve. And the peak of this cycle of inversion was minus 110.8 basis points on July 2nd, 2023.
Okay.
That inversion was so I'm sorry to be getting so out of sequence, but that inversion was so hostile, it was toxic to the banks. The Fed had to disinvert the curve, or the banks would have evaporated.
Why
And
is
so
that
where we
toxic
are
to
right,
banks, David?
well, because banks borrow short, they borrow at whatever a market rate is, and they lend at a market rate, and they charge a premium. Say if it's credit, they do all of their fancy analysis whether it's a worthy, like it's less risky than the market prices. But if the fundamental cost of money beyond those automatic savings accounts, which pay nothing, but as you mentioned, time deposits,
Bonds.
debentures, borrowings on the corporate bond market, and then shorter term instruments that trade off of government funding. If you're paying more for short term rates than long term rates, how are you making it?
Yeah.
Because what is a bank? A bank is a broker, a dealer, curve, and credit. So if your curve is upside down, you're paying more to borrow money than you're earning. Now, obviously, if something's a floating rate and you're charging a premium, sure. But those short term loans aren't really the bank's, you know, reason for existing. It's really the longer term stuff that doesn't reset every 6 months or a year. It's something that's the structure of the bank. So when the curve is inverted, like under Alan Greenspan, in March 24th, 2000, when the NASDAQ peaked in the dot-com era at 4,800 or $120.50 on QQQ, many people will know for context, he didn't start cutting rates until two conditions happened. The yield curve from the Fed funds to the 30-year yield inverted 134 basis points, and the NASDAQ fell 57% before he discharged 1 basis point of accommodation. So
Mhm.
he wanted to deflate equity risk, use that disinflation, deflation, asset deflation to shift over into price deflation. We have a different model right now. It's never happened in the 112 years of the Federal Reserve. No one's ever done what Powell's done, which is to just cut, and preserve the steepness of the curve, even allowing the market to make a new high.
Okay.
So,
So
what, yeah,
go ahead. Explain
one
why.
contextual thing is on November 20th, 2008, the NASDAQ 100 was 1,018. It
Mm,
had bottomed on October 8th, 2002, after the 83% drawdown during .com. So that went from $17.80. It went up almost a double, but it came all the I'm using the QQQ because a lot of people know that. We went from 120.50 down to 52 and then bottomed at $17.80. We went up to like 35. We went back down to $21, which equated to 1,018. And over 5,711 days, over 15 years, 7 months, and 20 days, from November 20th, 2008 until July 10th, 2024, you just went straight up. You went up from 1,018 to 23,000. That's 20 times. The S&P only went up 7 times. The Dow went up 5 times. So it was a massive performer, but it started with Greenspan deflating by letting the curve flatten, weakening the credit formation. Because if the curve's steep, you're borrowing cheap and lending long, you're making money, you're just expanding the money supply.
right.
But if the curve's flattening, banks like peeling two sides of the banana. They're just lowering their outstanding assets. They're in parity, as you described last week. They have to reduce their liabilities, or they have to go in and replace their assets. But that
Mm,
means they're pushing rates down. So almost think of it as like an orange juice press. When you're pushing the lever down, it squeezes the juice out, but it's inverted. And inversion is money loss for the banks. Steepness is money expansion by the banks. And so when you get into a world like Greenspan saw with the .com era, where we went up almost 300% since LTCM, the long-term capital management failure, August 17th, 1998, we have Powell just cutting. And the mechanics of cutting is you reduce the policy differential between us and the rest of the world. So we used to be much more, it gets closer. It's not as attractive for a foreigner. So
mhm,
that's causing dollar weakness because we don't have the more attractive rate.
right.
And so when he's easing, he's weakening the dollar. And that's just manna from heaven for the exporters like the FANG and for the S&P. At the same time, by cutting more than the market's ready, if you think about a surfboard in a lake and you push one side down, think of the water as the natural upward pressure at any moment of money supply. If
Mhm,
you push one side of the surfboard in, the other side's going to tip up.
right.
Now, if you've got holes in the surfboard, like we have called natural deflation, credit deflation, companies going bankrupt, you will slowly have the far end of the surfboard come back down, or like a canoe with holes in it. So whenever the Fed cuts, the immediate action is to put upward pressure on the long end of the curve, down pressure on the front end. It relates to, if we have time to discuss it, it's called duration extension or duration transmedial extrusion, where you're making something longer. But the simple case is when the Fed cuts, the immediate effect is a weaker dollar, which reduces earnings for the S&P and NASDAQ,
Mhm.
and you steepen the curve, which helps banks create more credit. This is the information gap I want to go through. Why we talk about mortgages as the leader, not the follower. The
Okay,
reason
so
why, you know,
but if I'm not mistaken, that
yeah.
you're bullish on the dollar more in this 1 year time horizon or 2 year time horizon. And
Yes,
right
but
now
not
you're talking about,
initially. Not
right, but let's talk
initially.
about
And
what,
similarly, the bull flattener you discussed, we start off with a bull steepener and that morphs into a bull flattener. And if I could just disaggregate for your listeners, bull means prices go up, yields go down. Bear means the opposite. And the shape of the curve, which could be called curl in vector calculus, it's called flattening or steepening in yield curve. So a bull steepener means short rates go down faster. A bull flattener means long rates go down faster.
right.
But if you're in a condition like we're in, we expect the bull steepener to migrate into a bull flattener. And that is the condition that we're in right now.
Okay, so let's
So,
focus on that for a moment, David,
okay,
because I've talked about on this channel and various places that I had a bull steepener trade on where I bought 2 years and I sold 10 years, and that worked well. I don't have that trade on right now, just FYI. But in listening to you talk in St. Bart's, I'm kind of reevaluating that. So I'd really, and I think my audience understands the difference between the bull steepener and the bear steepener, or now the bull flattener. So let's go into why you think we're going to
okay.
have a bull
This is the
steepener
key.
and
This
then
is
a
the
bull
key
flattener
insight.
after that. Okay, great.
The key insight. And just, for language, when you say you bought the 2-year and you sold the 10-year, it's really important to say you bought the 2-year and you funded that with the 10-year, because you didn't actually put up any cap. You didn't have to put up capital. That's
Right.
what the market does. It buys what it likes and it funds it with something it doesn't like. And that leads to failure later on. But for now, let's go why we're going to transition
And
from a
just so I can
steepen.
explain that, David, it's
Yeah, please
fascinating.
do.
It's fascinating you put things in those terms because that's what a bank does. That's exactly what a bank does. And since your background is in the primary dealer banks, it's just very interesting to me that that you use that terminology as far as you bought the 10-year, or excuse me, you bought the 2-year and you funded it with a short sale of something else. So you're funding something. And what that
Exactly.
implies
Because
is that banks aren't using their own money. They're using other people's money, and they're just,
exactly.
the bank is
And
just
relying
managing
on the Federal Reserve to bail them out when they're not properly hedged.
yeah,
And we'll go through that later. But I
exactly.
want to talk about the word funding for just one moment before we go,
Okay.
because it's so critical. My job, my role is to not worry about false positives of a failure, like some chaos. Like when you take a health test, you'd rather get a false positive than a false negative.
Mhm.
In other words, you'd rather not have something and not know about it. You'd much rather think you have something and discover later it's not terminal.
Mhm.
And so I'm looking for anomalies in the system across all assets, across all time frames, with all derivatives, and the vast majority are nothing to worry about.
Right.
But the butterfly effect, creating wind pressure, which accelerates and becomes a hurricane, we have to look and wait to see when the tail risk chops off. So if you imagine a number series 1, 2, 4, 8, 16, 32, 64, 128, 256, 512, 1024, that's 3 decimals. It's 10 flips of a coin. Every 3 1/3 flips of a coin gives you a decimal. Nobody notices the first decimal.
Right.
Things don't move out of order in the first decimal. When you get to the second decimal, everyone sophisticated like you is absolutely going to see it canonically. You'll say, "Hey, this is one. It's now 100."
It's an
And
exponential growth.
yes, and then when an individual investor sees that 7th flip, the good ones will say, "Hey, wait a sec. We're working on a third decimal. We're going to 1,000."
Mm.
So that's what we call nonlinearity or convexity. And most things just go away. Most troubles go away. But if you're watching 1,000 different people and they're all flipping the coin, all the ones that get the wrong coin move them away. The wrong flip. And then you go from 500 people down to 250. By the time you're down to one person, he's flipped the head 10 times in a row. Is he lucky or is he just 1 in 1,000? So I'm
Right.
looking at every anomaly. And so when we talk about funding, we talk about funding failures. Like everyone was shorting the 2-year to buy FANG. Why? It's cheaper than your margin loan at the bank. You just
Mhm.
have to pay whatever the 2-year rate is. Okay. And it doesn't move a lot. So how's it going to hurt you? But what happens when something goes to a 1-year high? What happens when a mortgage rate goes to a 3-year low and you're funding your FANG by shorting a mortgage? So
Right.
funding and funding failures is the end of the story, but let's go to the back to the beginning of the
But
story.
let me let
We'll
me
end
just
with
put that into
failures.
a
Yeah.
context that I think most people will easily understand. And I think a lot of my audience,
Universal translator.
well, there you go. A lot of my audiences followed what's happened with commercial real estate. and these office buildings. And so what happens with these office buildings? Let's say you buy it for $100 million and you borrow $50 million to do the purchase, and that's at a 90% occupancy rate. And let's just say a 2% loan, just throwing that out there for a hypothetical. And then what happens is after 2 years, you have to go ahead and roll that debt over. And because it's just a 2-year loan. So at the end of the 2 years, let's just assume for a moment that the interest rate has gone up to 4%. Well, now you've got a problem here, don't you? Because your cash flow might not cover the 4%. It might only cover a 2% loan. And on top of that, let's assume that
because your occupancy. Oh, I'm sorry. Please.
yeah, because your occupancy rate, let's assume, goes down during that time as well, to where now the bank will not roll over $50 million. The bank will only roll over, let's say, 25 million. And so now you got a big problem, because you either come up with 25 million out of pocket, or that property that you bought, you lose everything, and it goes back to the bank, and then they have to fire sell it, and they take a big haircut on their balance sheet. This is an example of a funding problem. And instead of just
Funding failure, funding
failure, I'm sorry. So what David's referring to isn't necessarily a funding failure in real estate, like the example we just gave. It's a funding failure for, let's just say, the financial plumbing and the financial system.
Or buying of tech stocks, of FANG, because FANG ran up 200% in almost 2 years. Now it has gone up 10%. It has not outperformed the S&P. And people who were funding in a 2-year, when the 2 years going down, they weren't just paying a 2% interest rate. They were making money on their short. It was a double barrel. So now that it's going up, they're having capital loss. And this was what
works in reverse. So that leverage on the way up, it obviously works in reverse if the opposite is happening, if the NASDAQ isn't going up at a sufficient rate to make up for the interest rates going down on your funding.
That's why it's so important for everyone looking at tech stocks. For the last 15 years, they were going up so rapidly, it didn't matter what treasuries did. Okay. But if
David,
you start to see
that, because if the funding, let's just say you're funding at the 2-year, if that interest rate is going down, isn't that beneficial if you're rolling it over, because you're rolling it over at a lower interest rate?
Your capital loss, because you're shorting an instrument that's going up in price. So your total cost of your funding is rising. So that a 2-year can go up to $112. It's a 6% deliverable coupon for 2 years. So if there's a zero interest rate, the maximum price of a 2-year note future is 112. If it's a 5-year, 5 times 6, you could lose 30% of your money. So if you're funding in 2-year and rates go down, the rolling, as you point out, is not such a challenge. But if you're funding in a 5-year, or what if you're funding in a 10-year? How about all these people funding in a bond that's down by 50%? So there's a lot of capital movement. And so one of the ways you describe the occupancy is, I say, if you have a 2% funding rate and a 2% vacancy rate, you can handle a 4% rate, or a 4% interest rate, or a 4% vacancy rate. You can't handle both.
David, so let me just let me think out loud here,
please.
And if I'm understanding it correctly, what these players in the financial, heavyweights here, what they can do is they can go into repo and they can borrow $100 million, just say $100 million, and they can use that treasury as collateral, but it's a treasury that they don't even own yet.
Absolutely true. Absolutely true.
So that they can basically get that money in repo, and now they have that treasury on their balance sheet and let's just say they own the treasury in advance. They use that as collateral in repo. They get the 100 million, and then they go ahead and they have to keep that as collateral for that loan. They use the 100 million to buy Nvidia, let's say, and then what happens is the rates go down, and see, that's what I'm missing, is because I'm assuming that collateral that they have to keep on their balance sheet goes down in price, but that would be if the yields are going up.
Yes.
So where's the disconnect here? What am I missing?
So when yields go down, the price goes up, so their liability grows because they're shorted
Oh,
effectively.
okay, because they owe that collateral
Yeah.
for the loan that they took out to begin with in repo.
Yeah. And if I can interject one thing so much because you brought up repo, you go to the Fed, what do you get for your treasuries right now? 4 3/8.
Yeah, reverse
What?
repo, right?
Yeah. What? I mean, if your collateral, you put your stuff on deposit. Let's just use it. You put your stuff on deposit at the Federal Reserve. They give you 4 3/8 on that. Okay,
Okay.
that's a way of them trying to draw liquidity out of the system to slow it down. What happens? Why would someone buy a 2 year at 360 like they're doing today, or a 3 year at 350? Not because they're getting more money than at good old, you know, our friends at Powellville. They're expecting a failure in the system, and they're going to charge usurious rates on repo. They're going to rent out their treasuries, not at 4 3/8, 5, 10, 15%. They're
Right.
expecting to be a shortage of collateral.
Okay, so let me explain that because I think that's
Please do.
crucial. I've actually done a video on that, so it's something that I do understand.
You understand so much. Your humility is unjustified and disgusting. Okay, because you know so much.
Okay,
Some of
so
us have that disease. I lost it a
so
little.
but okay, but I'm gonna write down here because I know what the rebuttal is going to be to that. But let me just explain here. So we've got let's just say a 2-year treasury, it's trading at 3.5, and reverse repo, the Fed, if you just give them your cash, you can get 4.5. Let's just those aren't exact numbers.
Easy numbers, great.
Yeah, easy numbers. So why would you do that? Like if you can get 4.5 just by giving your money to the Fed, why on earth would you accept 3.5 for a 2-year treasury? Well, the reason is because you can make a lot more than 100 basis points if the shit hits the fan and you have that collateral that everyone needs, because you can lend out, you can rehypothecate, let's say, that collateral to other entities out there that need the liquidity, and you're going to make a hell of a lot more than the 100 basis points that you're leaving on the table, let's say, by not putting that cash with the Fed. So that's basically what David is explaining. Now, David, I think the rebuttal there would be, okay, well, isn't that just these people that are buying the 2-year, aren't they just front running the Fed?
Yeah. So what? They're and also doing well. In other words, it's costing them 100 basis points.
Okay.
Okay. And they're getting some capital appreciation that neutralizes it. But the inversion of the Fed funds to a treasury, like Dr. Jeremy Siegel from Wharton, he says, I don't do this 210 stuff. I look at Fed funds because that's the real funding cost. The important issue here, though, is the market is losing liquidity. When the price of something goes up, it means there is a shortage.
Right.
When it goes down, it means there's a glut, a simple supply demand curve. Now, don't we have some tariffs that are being imposed? Doesn't that, according to S&P Global, mean the US deficit is stable? Didn't they acknowledge that the tariffs, although not mandated by law, by Congress, so they couldn't be incorporated in the Office of Management and Budget's assessment of Donald Trump's budget bill? So if you couldn't incorporate it, but it exists, there's not going to be any deficit. In fact, a scary thing you've all got to watch, because I'm trying to give you things to watch. Watch out for 325 on the 3 year, because 325, 3.25% is the weighted average coupon of all the treasury notes, which means if we go under there, there is no expansion of the deficit.
Yeah, okay,
From
so David, time out there. So let me explain why that's a problem.
or
Because
an opportunity.
right, but why that's a problem for the system?
Oh,
Because
okay. Yeah.
because what we were talking about there, guys, is the collateral. We were talking about the dealers, and David knows how they operate on an intimate level, and so they're trying to,
I
hoard.
prefer a technical level. I don't have romance with the banks.
Wrong verbiage there. Okay, so we're talking about collateral, and the collateral in the financial system, whether we like it or not, it's treasuries. It just is. You can be mad at that.
The global. That's the
Yeah,
go-to gold standard.
you got it. So what David's talking about is if the deficit is reduced, and that could,
When?
or when, okay, but in David's opinion, when the deficit is reduced, what you're doing there is you're starving the system for collateral. So as insane as that may sound, that we don't have enough debt out there, but
We
in
don't.
yeah, I know, but
That's what
people look.
Greenspan warned about. Bill Clinton, he says, Mr. President, you cannot operate the economy with a 3% surplus.
Yeah,
And
but
Clinton didn't listen. And look
I
what
know.
happened.
I know, but so guys, what we're not saying is that there's $37 trillion in debt, and it would be fantastic for the US economy to balloon that up to 50 trillion. That's not what we're saying. But what we
No,
are saying is that unfortunately, the United States debt, that 37 trillion, represents the collateral for the global monetary system. And so you have to compartmentalize the two. So if we were to
it's
reduce
100 trillion global turnover, or 105 trillion. Our debt isn't
needs
a
that
third of
collateral,
that.
that needs that collateral. The way I always say it in my videos, David, and the way I think about it in my mind is that the true base money, the dollar base money, isn't necessarily bank reserves. It's more so treasuries
It
and
has
more.
become that.
Yeah.
It has become that.
Yeah. So again, going back to this, guys, you've got to compartmentalize the debt, the supply of treasuries in terms of the monetary system, and the debt and the supply of treasuries in terms of its economic impact on the US domestic economy. And those two things are dramatically, or can be dramatically, different. So if you reduce the debt, let's say down to 30 trillion, that might be great for the US economy, just looking at it through that lens, but the whole entire global monetary system would implode. And if the
Exactly.
whole entire global monetary system implodes, guess what? It's going to take the US economy down with it. So David's just saying, okay, look, we've got these deficits right now. And even though we have these deficits, you still see the 2-year treasury trading at whatever, 50, 60, 70 basis points under reverse repo,
It's
And that
over
means
80 for the
shortage,
3-year
a
right now.
shortage of collateral, even though we've got 37 trillion of it floating around. So this tells you how much demand there is. So if we
That
reduce
doesn't include the
supply, you've got
70 trillion of unfunded liabilities. It's independent. We have
yeah,
70 trillion of them. Now, you know the Buffett rule, right?
yeah,
And we went from 105% S&P to GDP in 2008. We're at 139 in .com. We're at 210 right now. Can I tell you the Levenson rule?
sure.
The mistake of the Buffett rule is that we're no longer regionally compartmentalized economically. Those 7 FANG stocks are all exports. S&P's all exports. The denominator has to be correct. We use the global 100 trillion P, not the 29 US. Do we stop doing business overseas? Similarly, our 37 trillion of debt has to use the denominator, not of
Right.
US GDP, but
Right.
global GDP. So that's
Yeah.
the Levenson rule.
Yeah, it's actually funny you say that, because we've never discussed that. We didn't discuss that at all in St. Bart's. And I was being interviewed by Porter Stansberry the other day, and he was arguing how the long end is going to blow out because there's, way too much supply and not enough demand. And I actually used that as a rebuttal. I said, yeah, but we've got to understand that the treasury market is the bond market for the world. So you can't just look at US GDP. You've got to look at global GDP. And it's funny. That's your exact point you're making.
That's why we get along so well. We're globalists. No, we're not globalists, but we see things in a global perspective. Now, I would agree something about the bond will blow out, but that's decimal. We're going to give up a decimal. Rates have to go. Can we go to the rates now? And then we can
Yeah,
circle back later, because I know people. So when I look at markets, and I have a partner, we talk all the time, I don't get to look at only now. I have to look at everything, all the different moving parts of equity, debt, currency. We have to look at time series. We have to look at Fed policy. We have to look at U.S. policy, foreign policy. And what we're seeing is the greatest misunderstanding of the structure of rates in my lifetime. And I
mm,
started watching markets in the late 70s, before Saudi Arabia and the Hunt brothers squeezed silver up to 50.
right.
So What we have is the great mistaken piece of information, which is the key to everything. And we experienced this in the summer of 23 when Credit Suisse evaporated overnight. They had a security called an AT1 alternative tier one, called a COCO, a contingent capital. People think mortgage debt is debt. It's just not. A unified mortgage security that's owned by many people, many institutions, MBB, the ETF, pensions, insurance companies, all kinds of LDIs, liability driven investors. They have like a fixed liability, a pension payment, or someone's going to die. And they have to buy assets. They love UMBS. Why? Because there's no credit risk. It's essentially backed by the US government. But there's enormous risk in there. Because one of the things we didn't talk about in the banks, you know that you'll go bankrupt if you have a bank and you say you've got $1 billion of liabilities and only 900 million in the cash till, and then people find out about that. That's
Mhm.
Silicon Valley Bank. That's that's a loss of parity, asset liability parity.
Okay.
That you don't have enough cash. It happened one night with Jimmy Stewart. Everyone should watch it. You'll learn more about banking from that than almost anything else.
Yeah, and just to be clear, that was a movie on a bankrupt. What was the name of that? Darn it, that was.
Potterville, and it was Drew Barrymore's great
Oh,
grandfather.
but what was the name of the movie? Oh, it
It
was
happened
Wonderful
one
Life.
night, I think.
Wonderful Life, wasn't it?
A Wonderful Life. A Wonderful Life.
Wonderful Life. Anyway,
It's,
but so yeah, so what David's talking about there is just the bank going bust. It has negative equity.
because
That's
they have losses. They have losses on
yeah, yeah.
loans, so they go insolvent. But banks have another ALP, asset liability parity mandate.
Okay,
They try to keep their asset duration, the average life
right.
of their assets, in parity with their liabilities because we have cycles in the world. Strong economy, high rates, weak economy, lower rates in a generalized sense. So, do you really want to invest as a bank all of your money in a money market account? Where if the Fed drops rates, but you have longer term liabilities, what if you're a pension and or a life insurance company? You got to make money 6% a year for 40 years till someone dies. Do you
Yeah,
really want to be only making? So you have two things that must be in sync: the asset value, asset liability parity, but the duration, the average life of the instruments that you invest in. So
right.
when you were talking in your last podcast and you said you had a bit of an insight, you were basically saying the liability side has tremendous friction. You can't just return the debenture, the bond that you just borrowed money 6% for 8 years. No one's going to say they'll take the cash back when rates go lower. The
Mhm.
market value of that debenture would go up from 100 to 120 in the public markets. People want to lock. That was the risk that they took. So when you have a bank and they borrow, if they were to say, I want to borrow, but I want a puttable bond that I can just give it back to you. Well, that costs extra and they'll make no money because they make money because they're essentially borrowing it risk free off of the treasury curve because of the FDIC insurance that our society decided banks were the best way to create credit in the old days. But they're going away, thank God. Okay. It'll be better for people. We'll go through that another time. But when you have your dollar value in parity, that's great. You have your assets, liabilities, and you have an equity cushion. Okay. You don't want a negative equity cushion. That's bankruptcy. But you must keep your asset average life and your liability average life in sync. Otherwise, when you have economic cycles, that will push you into earning less than you need.
Okay,
And
David. So
so
let
when
me let me just explain that real quick.
if I could just the last piece is
Yeah,
you
yeah.
said you're really focused on the asset side, which is not which is not viscous. It moves around a lot. The liability is stuck there. Okay, please continue.
Yes, yeah, and the problem or the mistake I made is just looking at the liability side of the bank's balance sheet myopically through the lens of demand deposits. And as an example, JP Morgan's paying 1 basis point. So
Yeah.
what do they care if, Fed funds goes from 4.3 down to 3.5 or whatever? Yes, they're making less money, but then that's less money that they could allocate to paying those longer term set liabilities, or let's just say fixed rate liabilities. So what we're saying here, guys, is let's just say that you've got a bank that's got $1 million worth of liabilities and $1 million worth of assets. Okay, well, let's just say 100,000 of the liability are equities, or is equity, excuse me. So if they take $100,000 of losses or $200,000 of losses on the asset side of their balance sheet, then what's going to happen is that's going to blow out the equity. It's gone, and now all of a sudden they've got 900,000 of liabilities, and they have 800,000 of assets. They're technically insolvent. They're or could be. They've got negative equity there. They've got big problems. So what David is saying is that's number one metric that they're looking at as far as risk management. Number two is in order to hopefully maintain that equity or to grow that equity, in order to reduce risk, what you want to do is, if let's say all of your liabilities are just a 2-year debt, so you're borrowing for 2 years, what you'd like to do is have a 2-year asset, so that duration is completely matched up, so there is no
And the
what we
word
call
duration
duration risk.
means, and the word duration means the
It's
average
based,
life.
yeah, and then the interest rate as well. There's a calculation there, but the bottom line
Yeah.
is the price on a longer duration asset is going to go up or down a lot more, and
It's
that's
more
why.
sensitive to a change of rates, but it also just means the length that you expect it to live. So a 2-year treasury with 0 interest rates is exactly 2 times or 2% move for in the asset price, with a 1% move in the general level of interest rates. But if you have something that's got, say, 4% interest rates, it won't have the full 2% because you're
Right,
getting some of the money back. The best example is a 10-year treasury with 10% interest rates. You're getting
right.
all of your money back in 10 payments, and then you get your original amount. So it's less sensitive to interest rate movements when you have cash. But if you've got a 2-year liability on your balance sheet, you just funded with 2-year CDs, and then you've got to commit to paying 4% on those CDs for 2 years. You've got to pay 8% of that CD, 2 years at 4%. What if you have all of your money sitting in your T bills because, oh, I'm making a little more of my T bills, excuse me, in money markets or savings accounts? That money's not locked in.
Right.
It's expected to stay there. But what if you get a run on the bank because they find out you've lost some equity? It's Silicon Valley Bank. That's what happened to Silicon Valley
Yeah,
Bank.
but even if it doesn't, let's just assume that that
Yeah,
money market is an asset, or that
yeah.
cash that the bank is making whatever a spread on the liabilities. If that liability is fixed, then let's just say at a 4% interest rate. If what they're being paid on the asset side with these T-bills or bank reserves or whatever it is goes down to 3%, now they've got negative cash flow because they owe 4%,
Underwater.
yet they're only receiving 3%. And so this poses a big, big, big problem. So, David, why can't they completely match up duration? So, as an example, if they've got that 2-year liability, why can't they just have a 2-year asset? Is it just the fact that
They
they're
won't
trying
make
to
any
be more
money.
greedy?
They
Okay,
won't
yeah,
make no. They won't make any money. That's what Silicon Valley Bank, in my opinion, don't want to be sued. They didn't have adequate hedges, and they said, it's fine. The 2-year mortgage that ended up, if you have a 2-year mortgage, excuse me, if you have a 2% mortgage, 1 out of every 4 mortgages was canceled, refinanced, or purchased every year. So you're getting your 2% interest rate, and you were getting 25% cash flow from all the prepayments of people moving, people cashing out. What happens when they raise rates to 5 3/8 and mortgage rates went to 803 on 8/19/23?
yeah,
10/19/23 on October 19th, 2023. The price of that mortgage melted down 30%, but there was no activity. So you were starved of all that cash flow
yeah. In
and
other
all
words,
that
the
money.
amount of mortgages, and what he's saying there, guys, the amount of mortgages, not only did the price go down, but the amount of mortgages available went down as well.
But what I was saying is that in a normal, very low mortgage rate with a lot of housing activity, all these mortgages, 25% of them were canceling every year because
Yeah,
people were moving. Okay.
yep,
So you're getting your 2% interest plus prepayments of 25. You've got 27% cash flow.
Mm.
And that's meeting your depositors' needs because Silicon Valley Bank went from a $50 billion asset base before COVID to 250. A lot of tech money went in there, but that money was needed to fund. That money was going to be coming out. So if rates didn't go up, Silicon Valley would have been fine. They would have got all that cash flow, met their needs. But when rates went up, the mortgages, there was no activity, no one was prepaying. They went from 27% cash flow to 2% cash flow, and they
Okay.
couldn't meet the withdrawals.
So I think most people understand the dynamics involved with Silicon Valley Bank, but can you explain just a little bit more why the Fed dropping rates could put other banks at risk? Because we understand how banks are at risk if the Fed raises rates because of that mismatch. But I think part of your framework is
Okay.
that if the Fed
Okay.
drops rates, that puts other banks at risk because they have short-term assets, let's say, but they have longer-term liabilities.
So this is the big enchilada of our whole discussion. It's the mortgage volatility engine, mortgage volatility entropy, whatever you want. A mortgage is not a bullet. It's not debt in a sense because embedded in it is a short call option. The right of a borrower to put that money back and get a lower rate
Mhm.
or to end a call to keep that and hang on to it for 30 years, whichever works for them. And who's the victim of that wealth transfer? The bank.
Right.
And that's why the Fed will often cut rates to stop mortgage activity like they did September 18th, 24, when JP Morgan on September 12th said we're losing our net interest margin because mortgage rates fell 192 basis points from 803 on October 19th, 2023 to September 11th, 2024, 10 and a half months, rates fell 192 basis points. Whose pocket did that come out of?
Right.
JP Morgan's.
JP Morgan. Right.
And they went to the consumer. That's one of the elements of our view that we cannot go into a recession. We have $37 trillion. Mortgage rates are going to come way down. There's no way to stop it. The Fed stopped it once, but we talked about it on my podcast, my spaces in advance, what they would do, why they would do it, and the effect of steepening. This time it won't steepen. And this is what you're asking. When the Fed cuts rates, and I put up the chart, is there any way of you getting the 3-year
Oh, yeah. Yeah.
floating
I
rate on?
completely forgot we had those charts. Let me go ahead and pull them up right now, David. So you want me to pull up the
Actually, you
3-year?
know what? Let's start from the beginning. Can you do the global financial crisis, the COVID, and the dot-com era level of purchase activity? 4 trillion, 2 trillion, 2 trillion. That says in early 2000s,
Yeah.
peak year 2003, we did 4.1 trillion in 2021 dollars of mortgage activity. That's a third of all the existing mortgages.
At the time.
What kind of speed is that, buddy? Okay, how much cash flow are you getting? You
Right.
buy a mortgage, they're dumping a third of the cash back in your lap. You're not happy if you thought it was an 8-year piece of paper and you get
Right.
a third of your money. What are you going to do when rates fell? You're upside down, you're inside out. That's 4.2 trillion. Go to the next one, the post-COVID recession. We did, what is it, 2.9 trillion. My eyes are not great.
Up to
2.8.
2.8 trillion in
Okay,
strong
or down
years.
to, it's down to, because it was 4.2. Now it's
Okay.
down less. Okay. And then look at COVID.
2.8
Okay.
in 2021 alone.
Okay. So what's happening is we're seeing less activity. And it's still a huge number, 20% instead of 33. But it also means there's not a lot of supply. There's not
Right.
supply holding down mortgage prices. And that's the key insight. A mortgage can swell like a balloon and it could deflate like a balloon. So when Powell raised rates and caused mortgage rates to rise, and people said, I am not going to exercise my put. I'm not giving the money back to the borrower. I'm hanging on to it for 30 years. No cash flow. Good Silicon Valley Bank. We have the reverse of that right now. People have rigid liabilities. The Maginot line, the average liability of the system of a pension and insurance company, let's say it's 6 years. It's longer, but let's say it's 6 years. and you have an
Mhm.
8-year mortgage. So you have some 8-year mortgages, average life, and then you do some floating rate, and you combine them together to get an average life of 6 years. And if I could just interject, I know I drive you crazy. I want to give you the mindset of a mortgage hedger, someone who buys mortgages on funding. So a guy buys a bill, or a woman buys $1 billion of mortgages, and
Mhm.
they fund that when it has a 7.5 year average life with 500 million of 5-year note futures, 500 million of 10-year note futures. 5 and 10 equals 15 divided by 2 is 7.5. You're at parity. What happens when mortgage rates go down and that goes from a 7-year, 7.5 year to a 7-year? You're out of parity. You have risk of the
Right.
market continuing to move, and your funding is too expensive. What
Mhm.
do? You buy in 100 million of your 500 million short 10-year. So you're now short 400 million 10-year, and you lay that out, you sell it as a 5-year, so you're now short 500, 600 million, the extra 100 on top of the 500 million. So what do you get when you take 6 times 5, that's 30, 4 times 10 is 4, 3 plus 4 is 7. By pulling the $100 million and making it go from a 10-year to a 5-year, you're taking a half-year average life. What happens if mortgage rates fall fast? They're going to be buying all those 10 years back. If mortgage rates go to an average life of 5 years, you'll buy all those 10 years back.
Yeah. So, and
What
this is goes
happens if
back
it's
to your Bull Flatner thesis.
exactly?
Yeah.
Because the cash shows up under reverse Silicon Valley, excess prepayment, and you do one of two things. You replace that by buying something at a lower rate, either longer duration or a lower rate, the same duration, and you're putting downward pressure on yields, upward pressure on price. Or you just say, I'm just not going to keep my credit outstanding. I'm going to let stuff roll off. So you're peeling both sides of the banana. So you can either take the peel of the left side and stretch it back out, but pull it down and flatten, or you can just peel the assets and the liability side. So that is the death of bank reserves. That's the death of M2 growth, and that's accelerates. And now you can show that 3-year curve, that monster danger, showing that nobody on your listeners buys 3-year lows. Nobody does it. We know not to do that, right? Wait for it to like demonstrate that it's not going straight to zero. Isn't that the advice you give people?
Well, I say
If,
buy
if,
things
if,
when
it,
they're
if
cheap,
it,
but you got to wait for a catalyst. You got to wait for a catalyst.
or if it's or to stop going down.
That's the catalyst. Yeah, the
Okay,
chart. So
okay.
you
But
look
if
at the
it's
chart that we're doing,
if
right?
it's accelerating lower, that's definitely not a good idea.
Yeah,
You know.
you don't want to grab a falling knife, right?
Yeah, yeah. So please show that chart to show what
Oh,
do adjustable rate mortgages quoted today at 12 o'clock. So this chart starts August 19th, 2022, just before the Fed signaled that they're slowing the rate of rate hikes in the run up to Jackson Hole.
okay,
But they were still hiking rates. So this is the run up to Jackson Hole in 2022 on the left hand side.
okay.
And you see floating rate mortgages go from 5.82 up to the
Yep,
sevens.
yep. I
Okay.
see that.
This is 3 years and 2 weeks later. Round trip, buddy. Round trip. Is this something you would buy as an investor?
Yeah. So no, the answer is no. Looking at this chart because it's just going straight
Yeah.
down. It's a falling knife.
You would want to short it. You'd want to short that
Yeah.
if you're a short. Okay. So that
Meaning that
means
based on this chart, guys, that based on this chart and many other fundamental factors and mechanical factors, David's view is that these arms, these adjustable rate mortgages, that interest rates will go down substantially over the next year.
well, we just started. Okay. So the big banks, because there's now a big advantage, you're 64 basis points cheaper on a floating rate 7-year fixed period and
Yeah.
6-month adjustable for so if you've got to move out of your house, not death, divorce, work from home, just you got 2 kids, they're too big, it's chaos. You'd love a 30-year fixed, but you don't qualify because of the rate. And you got your paperwork in, but they rejected it. But then
Right.
you get a call and they say, if you take the floater, it's locked in for 7 years. You're probably going to move anyway. I can get you out. What happens when that happens? You're canceling that 8-year mortgage that the bank owned, and you're throwing that $1 million loan into their cash account. So they either need to reduce their liabilities, which are rigid, viscous, fixed, or they got to extend the life because you took an 8-year mortgage. What's 8 times 365? 2,750 days, approximately. You turned that into a 1-day asset.
Right.
How are you balanced with your asset liability duration? You took a 2,750 day asset and you converted it into a 1-day asset. You've got to stretch it out or remove your liability. Removing your liability shrinks the banking reserves. Correct? If
Well,
you remove an asset and liability, if you shrink
well,
both sides of the balance sheet.
it might not shrink the bank reserves. It depends what because the asset was the loan. And so that shrinks. And then the liability was, let's just say, the deposit. So the balance sheet shrinks, and all else being equal, you would reduce
You're
them
shrinking
too.
the credit for the system.
You're
If
definitely
they
shrinking
do
it too.
not, if they just say, we don't want to lend that out. We got the cash back. We'll use that cash to pay off the next loan. That the next debenture that matures will just pay off the debenture and the cash.
Mhm.
It shrinks both sides of the balance sheet.
Yeah,
Or if they
that's the
say,
main point.
okay, or they could say, you know what, let's buy something else, but it's at a it's a lower yield at a higher price. And that's the flattener dynamic. So we go with the tension of the speed of prepayments accelerating at a rate that the annihilation of the duration from the fixed to the floating, or the floating to the floating at a lower rate, the fixed at a lower rate. Because whenever a fixed goes to a fixed, you annihilate the value of the American exercise option. Your ability to have an option for 8 years, it's like a leap, an 8-year leap on your mortgage to put the paper back. You
Mm.
pay for that. You're wiping it away when you cancel your refund. So that just pulls down. So when rates are going down, you're shrinking the average life of the universe of mortgages, and it can offset fewer and fewer liabilities. And
Okay,
it's an accelerator.
okay, so let's try to just pause for a moment there to get everyone up to speed, or I'll try to do that. So, and then correct me if I'm wrong, or correct me where I'm wrong, David, just so we can kind of think this through out loud.
Thank
So
you.
if someone has a 30-year fixed rate mortgage, that is a liability of that person, but that's an asset of the bank that they can count on for 30 years. So let's just say that's 5% or something like that.
Can I just interject? It's a 30-year mortgage, but the average life based on behavior is 8 years. So
Okay.
let's call it an 8-year average life
Okay.
based on
thank
normal
you.
marks.
Yeah, thank you for clarifying, because when you're saying 8-year, people are going to assume that it was an 8-year mortgage, and it's not going to make sense when you're just
No, because
saying
the average life, because people move, they have an extra kid,
okay,
kids goes to college. So a
okay, so
30-year mortgage right now is about an 8-year average life. It was 4.5 years during the lows of COVID.
okay, so
It was so much.
the banks are being paid this cash flow. They've got that asset on their balance sheet for 8 years, and they can go ahead and match up. Let's see, if that's an asset, then they can go ahead and match up another liability based on that
They could
asset.
fund it. They
They can
could
fund it.
fund
There you
that
go.
asset with an 8-year debenture
Okay, so now, but all of a
or an
sudden they've
8-year
got an
CD.
8-year. So now they've got the 8-year asset, and they've got, or what they think is the 8-year asset, and an 8-year liability. So they're good to go. But then what happens is, if the Fed starts dropping rates, and if we get this big spread between fixed rate and adjustable rate, then when people start moving, especially because home prices are so high, they're going to be incentivized to go into an adjustable rate mortgage. And then what's going to happen is that loan is going to be paid off, let's say after 5 years. And now the bank's got a big problem, because that was paid off. They had the duration matched up, but now it gets paid off. and then they've got a lower interest rate if they go ahead and roll over that money into a new loan, and therefore they've got the interest rate mismatch. And now they've got the duration mismatch if they go into an adjustable rate mortgage, because likely the duration is shorter, obviously, than the
It's 5 right
30.
now. It's 5 right
It's
now
5,
and
okay.
falling.
So it's five compared to the 8 it was before. So then the bank is in a position where they have to somehow take more adjustable rate mortgages onto their balance sheet to get to average
50%
out,
more. 50% more.
right, to average out to that 8-year duration on the liability side. Or the other option they have is just to reduce the overall liabilities because they want to de-risk. And if they reduce the size of their balance sheet by not taking that cash and rolling it over into another loan, then you have M2 money supply, as an example, going down, all else equal, which is a reduction of the money supply, which is disinflationary, deflationary. And then you look at that through the lens of asset prices, which prop up the economy. And that's where, let's just say, the stuff really starts hitting the fan. And at the end of the day, I always tell my audience, I say in my videos, the Fed's balance sheet isn't necessarily liquidity. The bank reserves aren't necessarily liquidity. The true liquidity providers for the global financial system, especially outside of the United States, are the commercial banks and the banks in the Eurodollar system. So if they're shrinking their balance sheet, by definition, they're decreasing global liquidity. And in a debt-based
Can I
monetary
just
system, that's
modify that?
yeah,
Decreasing dollar liquidity,
yeah,
global dollar liquidity,
well
because
said.
we're a
Yeah, thank you.
dollar-based country, and that's the issue. Why, while the dollar may be going down now, there's going to be a shortage of dollars later.
Okay, so now we come full circle.
But I do have to interject because you said something, and you know you've always asked me to modify your statement if there's something.
Please.
So when you say when the Fed lowers rates, it causes mortgage rates to go up, down, excuse me. It's not always the case. It's
Right,
the case now because the
right.
Fed has used up all their shenanigans. But let me describe the two cases.
Yeah,
When we were inverted, okay, short rates were above long rates, and we had them cut 100, and the long end popped up 129, and mortgages went up 115, and we disinverted 229, or funds to mortgages went 215. We spoke in advance. The banks were hurt. They were begging for more relief. The economy was too strong. Inflation was too strong. The reaction would be massive disinversion, because when the yield curve is inverted, the floating rate is same or higher than the fixed.
right.
No one's going from one to the other. And when you go fixed to fixed, you're not really destroying that much duration. The only duration you're destroying is the leap, that 8-year ability to refinance, and you're cashing that in early American exercise, not European.
Hmm.
Now, if it's a lower rate structure, it's not 8 years, it's 7 years, et cetera, et cetera. But because the curve was inverted, you wouldn't have the jump from an 8 to a 5.
Right.
Now we're here. We got the 62. So let's go over the three things Powell could do.
Okay.
He could do nothing, in which case the long end would scream because the dollar would go up from policy differential, and people would say, wow, you're a real inflation fighter. And the NASDAQ would get whacked.
And when you say scream, the price would go up, the
I'm
yield would
sorry,
go down.
the price of bonds would go up massively,
Yeah.
yields would melt down. They forced down that 646 30-year fixed mortgage. They push that through the floor. They push those 15-year mortgages right into the fours because of Powell's hawkishness. Okay,
Hmm.
and its dollar strength would hurt tech earnings, which are very highly valued and
Yeah.
very high multiples. A lot of accounting issues. The divergence between net income and free cash flow is the greatest in dollar amount of all time, meaning they have things that don't generate cash or use cash, but they're using it to say their income is higher, like stretching out the amortization, let's say to 11 years at Meta, their chips, while the maker of those chips say they're no good next year because they're going to get better ones.
A lot
So
of
you have
financial engineering.
a lot of that. So when tech rolls over, or when tech has pressure on earnings from dollar strength because they're exporters, where's that money going? It's going to unwind some of the funding and shorting the 2-year to buy that. It's going to go from investors saying, I'm making more money on my iShares treasury ETFs. I'm making more money on my low volatility. So all those things are going to get, they're going to get that long rate lower if the Fed doesn't cut. And
Yeah, right.
you can see from there, there's not a lot of supply because we all know a lot of coupons are below 4%. A lot of activity happened
Yeah.
during the COVID era. So there
just
won't
to
be the
just to get,
supply pushing the rates. It'll just melt down.
yeah, so just to get people caught up there, David. So what you're saying is if Fed does nothing, dollar rips, that impacts the Mag 7 negatively. And then you're going to
Dollar
see
rips,
capital.
mag trips.
Right. So then you're going to see capital go from, or at least in your theory here, is that you're going to see capital go from the Mag 7 directly into bonds, which is going to lower the interest rates even further.
Yes, because there's funding of treasuries. So like you earlier discussed, if you just want to reduce the size of your balance sheet, you have all this cash come in, you just want to roll off some of your expiring debentures or CDs because you don't see the opportunities. A
Right.
lot of people are going to stop shorting 2 years when the Nvidia today got below the 50-day moving average. Okay. So that's if he does nothing. What if he cuts 50? Well, the curve's inverted. He's going to pull that 582 36 and a half month low. He'll pull that down 40 basis points.
What's 582?
5.82 is the current rate on the 7-year fix with
Okay,
the
got it.
6-month floater. That's the
Okay.
3-year low chart that you did. We're at like a 3-year low on rates.
And mortgages, to be clear.
On,
Okay.
on mortgage rates, yes, thank you. Adjust rate mortgages. The 5-1 is even lower, but this I have good charts for. If Powell cuts 50, he's going to pull that down. Just pull it down. You'll take us to 542. Do you
David,
know what
just
kind of housing?
let me give you, because the pushback there is going to be, well, what if he cuts and the long end blows out like it did in September of 2024? Why do you think growth and inflation expectations will go down if the Fed cuts? Why wouldn't they go up?
Oh, it's independent of growth. It has nothing to do with growth expectations. That's a
Okay.
whole other story that the bond has no supply. There's 10 trillion of T-bills, 10 trillion of swaps and floaters. There's 300 billion. It's not even 3%. It's 2%. The bond, most of all bonds are held by pensions and insurance companies, U.S. Locked boxes. There's
Okay.
very little treasure. So the Druckenmillers of this world, they're pushing it around. They're telling a narrative, but it only lasts. Remember, they said the 10-year was going to go through 5%.
Yeah.
Where's
So
the
did
10-year?
Jamie Dimon.
The bond, because he's talking his book. The
Yeah.
bond you can move around. There's no supply. By the way, I don't have it. I'm going to get it to you for either your next podcast or me. We talked earlier about Clinton blew up the plumbing of the market against the advice of Greenspan by running such a surplus. They stopped issuing bonds under George Bush from 2002 to 2006. There are no 20-year-old bonds that were originally 30s that are now 11-year, 12-year, 13-year,
Oh, wow.
14-year. So
So
we're
we're
going to
short.
run out of all that collateral starting next year.
Wow. I never thought of that.
We'll have swaps, but that's bank risk.
Right.
Actual gold standard UST
Okay.
made in America. There
So
isn't any.
So your view is if Fed drops, then fixed rate mortgages might not do much because of the 10-year, but the ARMs will likely come down substantially due to the middle of the curve.
But this
And
is
that,
the issue. Where's the arms going to get their demand from? People that currently have the 30-year.
that's right.
So
Okay.
they're going to turn that into cash.
Mhm.
And we're going to get to a point, a tipping point, where the shift from fixed to floating, which was 40% in '05, it's only 25 to 30 right now. The volume is going to pick up, the decay, the rates will be coming down. Nobody wants to borrow at 8 years. Everybody swaps out these days. Only home borrowers and road builders and building builders. What business wants fixed rates? Goldman and Morgan, they borrow at 20 and 30 and they swap that stuff right out because who knows what's going to happen with AI?
Yeah.
There is no
And
people that want to fund at that coupon.
I know, you know what else is interesting too, and I don't know if this is relevant, but you can tell me if it is the fact that the interest rate swaps are so negative at, I believe, 10 and 30 years.
That's
Which
right.
shows
Because
you,
nobody with a brain says, I know what the world's going to be in 30 years. I don't know
yeah,
what's going to be in 30 days.
right, but because you, what the negative interest rate swap implies is that more financial institutions favor an adjustable rate than they do a
Yes, because they cannot model what the world's going to be like if we're going to have a strong economy or a weak economy. So they'd rather pay a premium to make sure they're not far away from being able to service their debt instead of going out of business. We don't know. So there's such a voracious desire to grab duration as we're aging. But the way you put it, George, who wants to borrow other than housing or phony duration demand, supply from when Powell cuts and lengthens the duration of any. If you have a 10% T-bill and he cuts by 5%, you're going from a $90 to a $95. You're adding $5 on 100, on 10 trillion. So whenever he cut, he's just pushing duration at the long end of the curve. But where he's blocked right now, and what is the whole core, is as refinancing activity picks up, we must watch this every Wednesday. It's reported on CNBC, on Mortgage News Daily. It's where this chart comes from. They tell you what's the activity, and this is where we have a big opportunity, or other people have a problem. September 11th.
Should we go back to that chart, David? Just what chart are you referring to specifically?
You can look at the upside down bowl, the caisson. Yeah, that.
So this is the one that comes out every Wednesday.
So this comes out every day, but on Wednesday, every day you can get the mortgage rate once or twice a day on Mortgage News Daily. It's a free website and a free app. Okay. You can see what mortgage rates are doing. And on this, it shows we're 46 basis points lower than last year on this day. But we know that mortgage rates bottomed on the fixed rate at 611 on September 11th, and then it went up 115 basis points. That becomes the denominator of a year over year. So what happens when your denominator collapses? Your numerator if it stays stable, it's going to look like a hero, let alone if rates go down. So you're going to have so much zeitgeist about rising mortgage activity that everyone's going to jump in and they're going to want to refinance, purchase, all this stuff. And that's going to shrink the average life of these mortgages. It's going to turn this into paste or cash, and everyone's going to have to reach. And what I didn't say yet, and I'll just throw it in right now, this is not information about Bank America's balance sheet today. I don't have access to it. I don't have access to JP Morgan's balance sheet today. But I can tell you what it probably looks like with a 99.99% confidence rate. Okay. 4 Sigma, excuse me. They are short calls. They are short treasury calls. They're short mortgage calls.
What do you mean by that, David? Explain that. Short treasury calls. What does that mean?
They want to make money selling calls.
Okay.
Rates go down, they lose their paper. They harvest money. When you when you buy a mortgage, isn't it like buying a treasury and selling the call that if rates go down, if the trace goes up, you lose the paper? It's like a covered treasury. Synthetically, that's really what a mortgage is. It's all kinds of bells and whistles. But if you buy a mortgage and you're selling the option for someone to refinance at their will, put or call it away from you, so banks sell calls. And what happens is banks sell calls, they make the money. So they would say they get on the phone and they call Goldman Sachs. Bank of America, I got a trillion notional to go. Excuse me, $1 billion notional to go. What can you bid? And they've already called Merrill Lynch. And you say, you give them a lousy bid. They say, I'll take it. What do you do next? You're long all these calls and you think markets are going to move. You're wiped out. You sell? Exactly. George isn't just a universal translator. He's also got the answers. He's Karnak. So what do? You call Countrywide because they were an issuer. Took a couple months to get a mortgage done. They have all this interest. Interest rate lock. Who's taking that risk? Countrywide. Mazzullo. It was ended up absorbed by Bank of America. They don't care if rates go up. Excuse me. Pardon. They don't care if rates go down because the paper's worth more. What do they care about? They don't care if rates go down because the value of the mortgage goes up and they can get paid more for it. What do you think they would care about? The opposite.
Cash flow.
No, rates going down. Excuse me. They don't mind when rates go down because the mortgage is more valuable. They hate it when rates go up and the mortgage
Right.
is worth less because it's less
Okay.
competitive. So it's it's like a futures contract, to be announced, to be delivered. Okay, you've got to deliver mortgages to meet the requirements. If rates go against you, so they're always buying puts. So you're selling calls cheap from someone desperate to harvest that premium, that theta,
Mhm.
and you're selling someone who's desperate for protection because they're making their money on agency, on issuing the mortgage, but they don't want the interest rate risk. And
Mm.
so you're selling the puts at a premium and you're buying the calls at a discount. And so
Mm.
that's what the relationship between like a JP Morgan, and they're trying to make more money by selling calls. But what risk do they have when rates go down?
You're
They
right.
got
And
the cap for it. Yeah.
you explained this to me at lunch the other day. And what was that dynamic called when there's a difference between the price and
So
the
it's called
exact same call?
skew.
Skew. There you go.
Skew.
That's what it
So
was.
gamma is the measurement of price movement of an asset. Vega is the volatility of that asset. And skew is the differential between someone's desire for put protection versus
Right.
someone's eagerness for call protection. And
Right.
that
Right.
should normally be much more skewed towards puts, but sometimes optimism. People sell, I'm selling a put. Like every time the Fed cuts, all the algorithms in the system, when they cut, they immediately sell S&P puts. They want to
Mhm.
capture that put skew, and that drives the S&P up mechanically.
Huh.
And since the Nasdaq is embedded like a nesting doll, the 100 Nasdaq is inside the S&P 500. When you're buying the 500 S&P, the algos, they're also synthetically buying, and you're putting that extra buying pressure. And then you have hopium and AI.
Yeah.
But
Right.
what happens when the yield curve flattens, the dollar goes up, and the earnings go upside down?
Yeah. Yeah. Because they're
Okay,
basically synthetically long the S&P 500. Those algos.
exactly. So we were talking about the banking system, Bank America, J.P. Morgan. They're short calls to bring in extra P&L.
Right. Right. Right.
And when Powell says higher for longer, he's saying, don't worry, I'm not going to let treasury prices go up. I'm not going to go allow someone, you know, who sold them, called Bank America, JP Morgan, to lose the assets that they pledged when they
Yeah.
sold that call and take
Right.
them in out of parity.
Right.
Wink,
Right.
wink. Because
Right.
there is no dual mandate, folks, please. It's not true.
Yeah.
There's a single mandate: protect the banks that have
Yeah.
two daughter mandates. Because if the banks go bad, you're just going to have no employment.
Right. Right.
So the daughter mandates are labor and inflation. The parent mandate. So remember, on September 11th, you can check the CNBC video. Loretta Mester, retired Cleveland Fed president, September 11th, 24. She's on CNBC with Sarah Eisen. I actually saw it live, and she's saying she's good with 25 basis point cuts. This is during the quiet period of the September 18th live meeting. What's she talking about? These people aren't being very fair to you. So then JP Morgan comes out the next day through a spokesman and said, we're having some issues with net interest margin. And my personal opinion is they weren't. My personal opinion is they knew Citi was, because Citi's
Hmm.
calling them to offload some stuff and they don't have the bandwidth for it. So they were basically protecting Citi, which they got big problems, in my opinion. So
Right.
they said that. And what happened on the 13th? Loretta Mester comes back on 5 days, the middle of the quiet period, says, you know what? 50 basis points as an initial cut sounds like a good idea.
Yeah.
They moved the market to positioning 40 basis points. They tilted it with Greg Ip and what's that guy with the N, the Italian name? Not whatever, the other mouthpiece of theirs. And they scooched it up to 38, which is the exact most unfair position because you're maximum out from being right, 25 or 50, because you don't have a half basis point. So they intentionally made it chaotic so everyone would sell because they'd have no time. If they tell you we're doing 25, you know exactly how much duration to shed. You know exactly how much rates are going to go up, exactly how much your mortgages are going to extend. And so you adjust your book. But if they don't tell you what it's going to be and they put it at 38, halfway between the 25 and the 50, if they did 50, you got to sell treasuries to get in balance. If they do 25, you got to buy treasuries. It's
Mm-hmm.
like a seesaw. If
Yeah.
they don't cut enough, they're sucking the tide out, not enough duration, and then you got to buy it. Or if they cut too much, you got too much duration, you got to sell it. So that's what happened last year. JP Morgan demanded effectively more cuts than guidance with an inverted curve, no place to move that duration into, say, a floating rate. We're not there now. We're at a steep curve. And if they pull down the mortgage rate, they'll pull that down and accelerate activity so much
Right.
that it's going to push it and buy the long end as we're going down. So the bull steepener
Turns into a bull
becomes a
flattener.
bull
Right.
flattener. And that's because the speed, the prepayment speeds. And so I know this with certainty for now, $1 trillion worth of mortgage, which is a good sample, nobody's concerned. Nobody's concerned about the independent mortgage brokers like Rocket and United who push that paper right out to the end user. And this is another part of our information gap, our innovation. When the
Mm.
global financial crisis happened from the inverted yield curve, what happened to Fannie Mae and Freddie Mac?
They
They
go out.
they they ran out of money. They couldn't
Mm.
retain, which was half of all mortgages to fund everything, the ninja loans and everything. J.P. Morgan and the money center banks, they weren't allowed to make loans because they had so many credit losses with junk bonds out 20%. They weren't able to even make risk-free loans. There was no credit going into housing. Most people remember only cash transactions for the
Mm-hmm.
most part for a while.
Yeah.
That was like an embolism, a clot blocking the flow of information from one part of the brain to your arm. Okay. Neuroplasticity is the prayer that you can get the signal from your brain to your arm through another pathway. Well,
Yeah.
we have capital plasticity.
Yeah.
After GFC, we in 2019, January 3rd, formalized the unified mortgage bank security, where a Rocket, a United, which are now about 4 times each the size of JP Morgan from an
Mm.
issuance standpoint,
Wow.
they do the issuance and they push it out in a matter of days, weeks to the end user, the pension and the liability. We will not have a thrombosis. We will not have an embolism. We will not have a clot. We will not have any friction. We will get all of Americans who own homes with a mortgage and the prepayment option, which is default required. They will all see the value of that option rise because they won't have JP Morgan says, I can't help you. Fannie Mae, I don't have any capital for you. The capital now has a stent allowing the borrower and the lender 2 ways. Rocket United, wholesale mortgage, to the pension and the liability folks. And so we will not get a GFC type of recession. Rates will come down fast because there's no mortgage supply to keep them up, and nobody is not swapping for the most part. If you build a road, yes, you want a long liability. If you build a solar farm, yes, you want a long liability. If you build a tall building, you want a liability. But every operating business doesn't know what's going to happen in 3 years. They're not going to lock in a coupon for the future. So this is the information gap. Lower rates won't trap homeowners' capital and won't close off their ability to exercise their option. And when real rates rise and inflation's falling, we lost 7.7% inflation, 5.6 June of 2008, minus 2.1 13 months later, because you made worthless the American exercise component of the option. It couldn't be exercised at will. It had to wait until you unclog the system. We have created capital plasticity.
Right.
Residential finance gets directly with no friction to the end user.
Well,
So
so that
that's why
exacerbates the problem because in the past you had that friction to where people couldn't
it was
rotate,
trapped.
and
Exactly.
now all of a sudden they can rotate because they don't need the banks in the mix.
And what's special and why people say goodbye American exceptionalism, it's people who don't understand this. We, between private credit, disintermediation, our banks are only 25% of American credit formation, according to some sources. Okay.
Hmm.
That means that we're getting 75% away. Europe is getting 12% away, 88% of their credits formed at the banks, which
Mm.
means when our mortgage activity annihilates the durational value in an accelerating recursive method, shrinking the average life of our mortgage, whether
Yep.
just through Powell not cutting this time and causing it to sweep down, or Powell cutting and they both go down, or Powell overcutting and pulling the floating rate, which causes people to jump out of their 8-year fixed into the 5 and 4.
Yep. Yep.
Both mortgage rates are coming down. But what happens when our curve flattens, my friend? Swaps, hedges, the entire global curve. I heard someone talking before we got on about UK debt. The UK is the size of California.
Right.
Okay. It, we are the granddaddy. Our rates are going lower. When we have the reality of the revised Fed, whether it's Zerbos or Malpass, and they recognize that growth doesn't cause inflation, regulation causes inflation. And so this this liquidity into home finance will cause a perverse thing. And this is where people have difficulty processing. This is why I hope this is recorded so they can listen over and over till it gets in there.
We're
Okay.
recording. Don't worry about
It
it.
it is that when the curve flattens, when a treasury yield falls, you lengthen the average life of that treasury.
Mhm.
When you sell a call against that treasury, no. You shrink your average life because someone else owns it. They give you the cash back.
Mhm.
On mortgages, rates go down. You speed up the prepayment speeds. You get more and more and more and more cash that's got to get pushed out more and more, which then is recursive. And it's a fly which is melting it down. And so mortgage volatility that was elevated by policy of Powell jacking rates from August 2nd of 2002, when I was up at 2 in the morning watching Japan. And I sent a message like, if he does nothing, we're going to get the mother of refi waves. He goes and starts the Jackson Hole. We went up 183.3 basis points in a few months.
Do you
And
think
that
he
was
knows
it.
this, David?
He absolutely does not know this. And you know how I know? Alan Greenspan was appointed chairman of the Federal Reserve on August 11th, 1987. 50 days later, the crash of 87, minus 40% for the market. In
Right.
Greenspan's first bookend, he finishes the job minus 83% from the dot-com era.
Mm.
Okay, not a great record, but he's the smartest Federal Reserve chair ever. Okay.
Maestro.
The bet, yes. He said famously, I always found it a conundrum. Well, when I raised long-term rates, short-term rates, long-term rates didn't follow. This is
Yeah.
the issue. When you raise a rate, you're shortening the duration of the instrument if it's a treasury. When you shorten the rate, you're lengthening the instrument. As a mortgage, no one is discharging cash flow by refi.
Yeah. As far as
That's
the
what
duration,
Silicon
yeah,
Valley did.
because people, let's just, I don't know, we're going long on time, David, but this is just
Okay.
an incredible conversation. But just explain to people how duration, because they use that word synonymously with maturity. And
So it's very
people
close to
are getting
maturity.
confused because they're like, look, if I have a 10-year treasury, if the interest rates go up, how is that reducing duration? Because they're just thinking about in terms of the maturity, the
Okay,
10
if
years.
we can think of a zero coupon bond, which is a treasury instrument stripped off by the Fed, you don't get any interest payments. You only get the principal. All of the expected rate of return, let's say it's a yield to maturity for a 10-year treasury and it's trading at, let's say, 4 times 10 is 40. That's about a little more than a 50% increase using the rule of 72. So it's about a $65 piece of paper.
Mm.
All of your interest will be automatically credited impliedly until it goes from 65 to 100. What happens if you get a 10-year treasury that pays a 10% coupon?
Right.
You're getting all $100 back. So it's going to be much less sensitive to interest rates because your weighted average time to get your money back is 6 years.
In other words, lower duration. So, guys, the bottom line here is really the definition of duration is how sensitive
Sensitive.
it is to interest rate movements, not necessarily the maturity, although that is a component of the
Yeah.
calculation.
But because you have an option embedded in a mortgage, that causes much less viscosity, much less predictability. You know exactly the moving parts in a parallel shift in the yield curve when rates go up.
Mm-hmm.
But if rates go down, that mortgage, you're just going to lose them to refinancing prepayments. Now, initially, it's not affordable because we have a higher asset price, so you need to borrow more money to buy it. But what happens when rates fall and start to clear and let some people that failed their mortgage app, and now, you know what? Miracle of miracles, wonder of wonder. That basis point from 611, that September low, which you couldn't qualify, you go to 609, you qualify. 608, more people. The lower you go, the more people are included in the universe of people that can qualify and speed up the process of this mortgage and it accelerates.
Which more arms, more shorter duration, bigger problem for banks.
Major. And so when you flatten our curve, not only don't you hurt our banks and force the Fed to then catch down, so
Yep.
they'll go 25, 25, 50, 50, 50, 50.
Yep. Yep.
But what does it do to treasuries around the world?
Yeah. In
Which
other
there
words,
really aren't that many long ones. There aren't that many long ones. It's just a story.
right. So you're flattening the curve for global financial institutions, not
Our
just
curve
banks.
and then swaps everyone's curve. But what happens if your credit is formed at banks and you need a cheap and steep and your curve flattens? Europe starts to cut rates to get their steepness back, which is why they went negative rates. Switzerland's at zero now and they're going minus 100.
And why you're bullish on the dollar?
Because
No,
what
that's
happens
why
when
that's
you have
one.
fewer dollars? What happens when you have fewer dollars?
No, but that's what I'm saying is there's two things there, guys.
Oh,
Why
you
David
said that's why, not why.
Yeah, yeah,
I
that's
didn't know
why.
that.
Because you're talking about interest rate differentials because those other central banks have to try to steepen out their curve, and
Because that's
therefore
where they
bring
get their credit.
rates
Seven,
down. They
seven
get
eighths of their credit versus
right. So when they
one
get the
quarter for
interest
us.
rate differential, that's a tailwind for the dollar, all else being equal. And then you combine that with this, let's say, deleveraging, and it's like a feedback loop where the higher dollar means deleveraging, means a shortage of dollars, meaning dollar going even higher, meaning and then that leads to the central banks having to cut even more and create a bigger interest rate differential, which just pushes the dollar up higher. So that's kind of
And what happens with a stronger dollar? We had a dollar fall 10% and we barely could get 2.7% inflation. What the hell's going to happen when the dollar's going up? It's going to kill inflation. Expectations are going to, inflation expectations have been nurtured by political people, in my opinion.
mm,
They were suppressed in the last administration. They're massively amplified now, but they're fragile when the truth hits them in the face. When
which
that 2 year yield goes, when that 3 year yield goes to 100 basis points below the Fed and doesn't slow down, when the dollar goes up and money markets go down and people say, you know what, get me out a little further on the curve,
yeah, right.
all of these things, there's nobody that wants to borrow in the long end. And then we have asset deflation leading to price. So it's a shortage in
Bull
the
flat.
treasury market.
No, they're bull flattener, which what David's talking about right now is the long end of the curve, just substantially coming down, just lowering interest rates and likely lowering mortgages even further. So there's like 4 or 5 doom loops that are going on
That, the
simultaneously.
vectors of pro-cyclicality, we call it. Okay. So
Right.
when you ask where do I think we're going, I think we go below the 2022 lows in yield.
Oh wow.
And oh yes,
Okay.
equilibrium for getting these mortgage rates. Remember, 4 trillion after .com, when a dollar meant something. We'd have to go to 8 trillion to meet that, right? That's 25 years ago.
Right. Right.
Okay. Well, what happens if there's only 12.5 trillion of primary and you're doing 8 trillion? What kind of speed is that, my friend? It's a lot of speed.
Yeah.
How about the extension? So you're going to take this mortgage volatility, which was inflated by policy by this rapid extension, the 25, 50, 75, which on May 4th, I remember where I was. I was at a memorial, May 4th, 2022. We said, we're only going 50s for 3 meetings.
Mhm.
That didn't last too long, but they did 25, 50, 75, 475s, 50, 25, 25. They did a skip, then they did a pause, and we widened volatility. And it was a field day for people. I love shorting volatility when it's high. How much higher can it go? You
Right.
sit there, you get noise, it moves up and down, but you're harvesting all this daily premium called theta. It's
Yeah.
not so easy shorting cheap volatility, but juicy volatility, like we spoke about on April 21 on my Polarity Radio podcast, a prompt Vegas suppression driven Fang rally. It was the greatest volatility crush maybe on record, and it was the biggest move in the S&P since 1982. And parenthetically, if I could throw this in, Bitcoin is 4 times as volatile as the S&P. It
Mhm.
used to be 10 times as much. But the S&P went up 34% from its low. Bitcoin's only 44% above its low. It should be 136% above the low. It should have gone up to
If the
160.
ratio maintained.
So the volatility negative divergence is observable. We didn't have volatility parity. We're always looking for negative divergence in gamma, in vega, in skew. We're always looking in every time frame and every derivative level
Mm.
because it could become something. I'm not
Right.
saying Bitcoin couldn't go to 200,000 tomorrow, but
Right.
the fact that it's failed to overtake the S&P's volatility adjusted price makes me comfortable being short its volatility. And as
Mm.
that goes lower, kids aren't going to want to play in that.
Mm.
They're going to want to play in small stuff that they can bang around in a
Yeah.
generalized sense. So you have to disprove a negative divergence by having a reassertion. But until then, and then what happens if Bitcoin takes out the 75? Because we were short at the beginning of the year after the US 10-year hit a peak on January 13th. Bitcoin hit a peak on the 19th of January. So once we had the first ugly day 2 days in a row with no new high in the 10-year after straight ascension, that let us know that the credit expansion's over. The policy driven credit expansion is over. So that allowed us to accumulate the short. And on April 8th at 4 a.m., in my highlights on my Twitter feed, you can see below 76 is a cover. It was 75067. That was at 4 a.m. on April 8th. And
What was that? What was you said 76? What was that? You're talking about the
70
volatility?
below 76, I would cover the short in Bitcoin. That was on
The
April
volatility
8th.
is what you're
No,
the
no,
number
that
you're
was just the
referencing.
cash. That was just the cash. I'm using
Oh,
the
I'm talking about 76.
volatility
Okay, got it.
to judge. There's some way that people, maybe I can help them think about it. A tube of toothpaste has a thin nozzle.
Yeah.
If you squeeze it, what happens? The toothpaste comes out.
Yeah.
Try to think about the tube of toothpaste as volatility and the extrusion out the nozzle as gamma or price. The
Mhm.
higher the volatility, the more difficult it is to get something to go up, to go out durably. If you squeeze the volatility, you're sending more toothpaste out.
Right.
The lower the vol, the more something can move. The higher the vol, it's like a syringe sucking in the solution, for the injection. So when we had vol coming in and you had the 10-year, you had all these things, but when something went below its 50, all these moving averages, and then you're looking for Trump to clean up his mess with a spoof of the Liberation Day, I'm out of here. That was too much.
Right.
But if we go, which we expect, below 75, that means you're taking us back to April. And if you get there anytime this fall, or next year, do you really want to have Bitcoin go nowhere for a year while vol's melting? And how many people are in these IBITs, these ETFs, that don't have the hodl mentality? They
Right. Right.
got to
Right.
liquidate. They got to come up with money. So we watch price not so much to take a big position in Bitcoin. You can't do that, but to watch it as its behavior. People used to do the Dow theory. When the Dow Jones, the utilities, and the transports made new high, Goldilocks. When the Dow, the Nasdaq, and the S&P, Goldilocks. But what happens if Bitcoin doesn't make a volatility adjusted new high? It's a possible, it's a possible fail. So we'd like to watch all of these things. But what I'm asking everyone to watch is on Mortgage News Daily, I want you to watch daily what's happening with the mortgage rate. I want you to go on Wednesday on CNBC or Mortgage News Daily and find out what, or you can Google it, what the Mortgage Bankers Index is telling us about purchase activity week over week and year over year. Because as we rise,
Yeah,
that's
we
the
got
death of
problems.
duration. And
Yeah.
before you know it, the dollar, which people short the dollar on 10-year differentials, they're going to get bought in because it's not about the 10-year only. The 10-year is a lot of supply, the 10-year differential, but the 10-year differential will lead to the global flattening, which will cause policy response in Europe, leading to the policy
Higher dollar.
widening. And
Yeah.
then the dollar will be sniffing this out just like the 3-year. And
Yeah.
the
Right.
last thing people always ask me, what's my favorite yield to buy? The lowest. What's my favorite yield to sell? The highest. Because
Mm.
I don't want to outthink 8 billion people. The gradient of the catenary, the gradient of the yield curve, the lowest yield, you buy. And if the 3 years the low, you have to buy 2s or 5s in futures. But if the 3 years the low and I'm buying the 5, when the 10-year goes below 5, that's me. Because you're making about 90% of the return in the 5-year with half of the volatility of the 10-year until such time as 10-year vol goes down and 10-year prices rise, because you cannot get a major rise in any asset with expanding volatility. It doesn't work that way. You're locally trapped. That's all the information.
And so,
Anyway, it was, yeah.
yeah, I just want to try to wrap things up here. So,
Okay.
David, or for the audience here, I don't think the key takeaway with the last 10 minutes of what David was saying is that he's bearish on Bitcoin or anything like that. What I would strongly encourage you guys to do is just rewind and listen to this over and over and over again. And what David was explaining there was not just a bearish position on Bitcoin, but more so a framework for how he sees assets through the lens of volatility. And if
And
volatility
skew,
is
and
and
skew,
skew and
and
in the
kurtosis.
options market,
Yeah, yeah,
right?
yeah.
And so that's his starting point. And so I think that's what's so unique and what's so interesting. But I think what we have to understand, guys, is, and David, correct me if I'm wrong, but I'm assuming that's your starting point because of where you started in the business. Because if you start at one of these, let's say, primary dealer banks, then that's how you're learning the system. And that's how you're learning, and that's where your edge comes from. So compare that to, like, let's say a Druckenmiller who didn't start in that position. He just looks at equities through a completely different lens, or a Buffett looks at them strictly through a valuation lens. You, being a primary dealer guy, let's say, you're looking at everything through the lens of how they manage balance sheet and how they see volatility. And what we have to understand is there's a lot of guys like you in the world, and they move markets and they control a lot of capital. So we're doing ourselves a disservice by not understanding this framework to the best of our ability.
Which one is more liquid, Microsoft or a $2 stock that trades by appointment?
Right. Microsoft,
Okay.
obviously. Right.
What is the turnover of dollars in the world? 100 trillion. So the world starts at a 0 time to expiration asset called the US dollar.
Right.
If the
Right.
dollar's going up 20%, you better believe over time the stock market's going to go up much more. But in the short run, if you have a rising dollar and an overvalued stock, that can converge. Conversely, a weaker dollar is very bad, as we know from China, for an equity. But in the short run, you can get interest rate differential. So the
Yeah.
point is that we start at the singularity, the 0 day to the 0 time, not day, the 0, it's an instant, the dollar. Then what is a dollar? After a dollar, you make a yield curve, a time deposits on the dollar. And then from the yield curve, we then stretch out credit. And then from
Mm-hmm.
credit, which equity is a credit feature, it's mathematically credit. But then we go up on the derivatives. So the first derivative, gamma, with respect price with respect to time. The second derivative, vega, volatility. The third derivative, skew. The fourth derivative, kurtosis. And that's all like a black hole. Each derivative contains all the information of everything else. So over time, as you learn to watch all of these different things in all time frames across all assets, intermarket. You have the information, but for the average person who's not going to be there now, just watch price for big and liquid things. If you see 13 trillion US mortgage market having a lower mortgage rate, is that telling you there's not a demand for money? More lenders than borrowers? That's
Hmm.
what it's telling me. And because a mortgage is not a treasury, the lower the mortgage rates go, the more problems it causes for banks, and they end up shrinking their credit. And then when you finally see the dollar go up in this context,
Yeah.
it ain't going lower. It ain't
Yeah.
going lower, in my opinion.
That's liquidity drying up, guys. That's liquidity drying up.
Watch
Okay.
2 year, watch 5 year, watch mortgage. Those go up, uh, those go down in yield. The system is talking to you.
Yeah. I think what I'm going to do, David,
Yeah,
is do like a full whiteboard, like a 30-minute whiteboard video
that would
on
be great.
this.
Yeah.
And just because I know people are going to be lost right now, but it's just, I think everyone's going to be fascinated, but I just need to just kind of explain it in a language that everyone can understand. So I'll save that for the whiteboard. How can people find out more about what you do?
Okay, so right now I have on Apple and Spotify, it's called Polarity Radio with David Levenson. It's no fee, no subscription, anything. I'm on the X platform at Levenson, Levenson underscore David, or you can search hashtag TMOM, the mechanics of markets. We used to be the physics of finance, but it was a little too much quantum mechanics and markets, which to me they're functionally equivalent. And if you could learn that, you're going to be the best trader. And when they say quant, they don't mean that. And hopefully, with George's help, won't be competition, will be different, but he's going to help me set up a YouTube channel where I can invite great guests like George.
Yeah,
But I
absolutely.
want to thank George for having me, because one of the things I ask people on my spaces, I don't charge a subscription. I don't ask anyone to donate to my charity. But I ask people if they think they've made money at some point from something they've learned. Please lend some money to a relative, donate to your community, or just give some time to the elderly, a blind person, or a child. And then when you learn this stuff better and you're more confident, train other people to help them learn how to not make the mistakes that we've all made in the past. So,
Yeah.
with all that, thank you, George, so much for having me on. And I'm always available to your listeners. Just give me a little notice. I won't always have this boring background. Maybe I'll be in my car, but it is so great. And, if you say to me, David, something bizarre happened in the market today, can you give us 15 minutes that I'll patch on to my regular stuff, something really urgent? Powell do something crazy. The market's acting crazy. Is this durable? Do I think it's temporary? I'd be delighted to provide your listeners with some of that
And so
context.
the best way for them to reach out to you is on X.
So on X,
Yeah.
because you could send, you can you can post to any of the comments. People, I do spaces on X that they convert over.
Okay.
Eventually, I think, according to you, I'll be doing it on YouTube, and they'll be able to message me through there. But we just want people to unlearn all the negative ad supported fiction that I just think is dangerous. The
Yeah.
price is right when it's deep and thick. It's not $2 stocks by appointment. I don't ask people to listen to me. I ask them to listen to their eyes, what they can see. This is not Popeyes where Wimpy promises you payment on Tuesday for a hamburger today. I like it the other way around. I will give you a hamburger on Tuesday for a payment of the hamburger today. I
Right.
need evidence. You don't need to be early if you're not leveraged 20 to 1. If you're not on a dealer desk and ripping your hair out because you got slammed with a billion of Bank America toxic waste, and you've got a weekend coming and you couldn't offload enough of it to Mozilla and Countrywide because he was so busy, you don't have a good weekend. But here, when you're not on leverage, after the World Trade Center collapsed, the market only moved 5% that day. I liquidated everything I had and I bought junior gold miners that day
Hmm.
on the 17th when they cut rates, because I knew they would print money with reckless abandon, because large governments would have every right to do that from their populace. I think the populace has changed minds right now. But I don't give advice on individual companies.
Yeah.
I give advice on the direction of sectors. I don't give advice at all, but my lens is about what's the sector telling us. So you
Yeah.
asked earlier about FANG, the tech. I think the money flows towards things that benefit from a stronger dollar and away from things that are hurt by a stronger dollar and away from things that are hurt by a flatter curve known as the financials
Mhm.
in favor of things that are regulated like utilities, healthcare. They're regulated. Staples are addictions. You have to eat to live, or you've got to drink Coca-Cola or McDonald's. And then we're starting to see outperformance of the small cap. They call it Rush. Russell 2000, utility, staples, healthcare. I will give you one final number. March 24th, 2000, the peak of the QQQ, the Nasdaq 100. Staples went up 45% while the Nasdaq fell 45% over 9 months, 40 weeks. That means if you put $100 in on that day in Staples, you got 145. If you put $100 in the Nasdaq 100, you had 55. 145 is nicer than 55. It worked for a very long time.
Mhm.
Markets go up 85% of the time, but they must reset.
Right.
And my optimism for our next is I think the banks in America are going to shrink in terms of the ratio of credit formation from fragile, moral hazard, involuntary depositor led credit formation to the much more rigid private credit, private equity, public markets. So they're not going to stop raising rates at 5 3/8 next time. They'll go much higher. That bond credit bubble, we may not only go up 20 times in the NASDAQ, we may go up 30 times, but we have to do this reset in my mind because there is nobody that wants to borrow in the long end of the curve other than people that were forced into it by Powell's preemptive cutting. We don't have that anymore because he's in the position where the mortgage rates are heads he loses, tails he loses.
Mhm.
Mortgage rates go down either more in the short end, more in the long end, or equally, but they don't go up. And that's the difference from the inverted curve to the steep curve. He's at maximum Screwville.
Yeah.
Anyway, thank you so much for having me on.
Thank you, my friend. Thanks for the time, and I can't wait to do it again. I can't wait to see you again in St. Bart soon.
We're going to be getting Hugh, according to some messages, to maybe do it in June or April because he needs to do more than once a year. He
Yeah, yeah,
needs to do it at least on both sides of the off season.
yeah. All right, buddy. Have a good one.
So long. Thank you.